Welcome back to Finance Currency. In the world of finance, there are moments that define everything that comes after. Moments where the market sends you a signal so loud, so unmistakable, that ignoring it would be financial suicide. Sunday night, January 19th, 2025 was one of those moments. Silver did not just rally. Silver did not just climb. Silver exploded to a new all-time record high of $94.11 per ounce. Let that number sink in. $94.11. For context, just 2 months ago, silver was trading at $48.64. In 60 days, the price has nearly doubled. This is not normal market behavior. This is not organic growth. This is a market in crisis, a market where something has fundamentally broken. But here is where the story gets terrifying. While retail investors were celebrating the new record high, while silver stackers were posting screenshots of their gains, one of the most powerful banks on Wall Street quietly released a note that should send chills down your spine. JPMorgan, the largest bank in the United States, the institution that has been accused of manipulating the silver market for decades, just issued a warning. They said, and I quote, "Mounting risks from loosening ex-US supply and ETF outflows to softer industrial demand and tighter Chinese trading curbs leave silver vulnerable to a sharp correction." Read that again. Vulnerable to a sharp correction. This is not some random analyst on Twitter. This is JPMorgan, the bank that settles more precious metals trades than any other institution on earth. The bank that has paid billions in fines for market manipulation. When they speak, the market listens, and right now they are telling you that silver is in danger. But wait, if silver is in danger, why did it just hit an all-time high? Why are buyers flooding into the market? Why is every dip being bought with aggressive force? This is the contradiction we need to unpack. This is the puzzle that will determine whether you make generational wealth or suffer catastrophic losses in the coming weeks. At 0108 GMT on Monday, ZAG USD was trading at 93.91, up 379 or 4.20% from the previous close. This gap higher, this Sunday night surge, tells you something critical about the psychology of this market. Traders could not wait for the regular session to open. They saw the opportunity and they pounced. But here is what the mainstream media is not telling you. Friday's close was $90.12. The previous record high was $93.51. The market just gapped above both levels in a single move. This is what technicians call a breakaway gap. It signals extreme conviction from buyers. It signals that demand is overwhelming supply. Yet JPMorgan says silver is vulnerable. Something does not add up. Let me translate what is really happening. There are two forces colliding in this market right now. On one side, you have the physical demand, the stackers, the industrial users, the people who actually want to hold real metal in their hands. On the other side, you have the paper market, the banks, the algorithms, the institutions that trade silver without ever touching an ounce. The physical market is screaming buy. The paper market is whispering sell. This is a war, and you're caught in the middle. The fact that silver hit 94.11 on a Sunday night when liquidity is thin and the US markets are closed for a bank holiday tells you the physical buyers are in control. They are setting the price. They are dictating the terms. The algorithms can push paper prices around during regular hours, but in the quiet of a Sunday night, the truth emerges. But JPMorgan's warning cannot be ignored. They mentioned 4 specific threats: loosening ex-US supply, ETF outflows, softer industrial demand, tighter Chinese trading curbs. Each of these is a potential landmine. Each of these could trigger the correction they are predicting. In part 2 of this deep dive, we are going to dissect the technical structure of this rally. We are going to identify the exact price levels that will determine whether silver goes to 120 or crashes back to 70. The chart is painting a picture, and if you know how to read it, you will see both the opportunity and the danger. The record has been broken. The warning has been issued. The battle has begun. You need to understand what happens next, because the next move in silver could be the most violent we have seen in decades. This is not a drill. This is not a test. This is the moment the silver market has been building toward for years, and you have a front row seat. Stay with me. Before we decode JPMorgan's warning, we need to understand the battlefield. In any war, you need to know the terrain. In the silver market, the terrain is defined by price levels, support levels, resistance levels, trend lines, moving averages. These are not abstract concepts. They are the lines in the sand where buyers and sellers fight for control. Let me walk you through the technical structure of this market, because what I am about to show you will either terrify you or give you the conviction to act. First, let us establish the trend. Silver is in a confirmed uptrend. This is not opinion. This is mathematical fact. An uptrend is defined by a series of higher tops and higher bottoms. Look at the chart. Every major swing high has been followed by a higher swing high. Every major swing low has been followed by a higher swing low. The pattern is undeniable. The most recent minor swing bottom is $73.84, set on January 8th. The main swing bottom is $70.07 set on December 31st. As long as silver trades above these levels, the bulls are in control. A trade through $70.07 would change the main trend to down. That is the line in the sand for the bears. But here's where it gets interesting. From the November 21st main bottom at $48.64, a trend line has been guiding this market higher. This trend line currently sits at 79.59. It has stopped the selling twice. Once at $70.07 on December 31st, once at $73.84 on January 8th. Every time the bears tried to break it, the bulls defended it with fury. This trend line is sacred. If it breaks, the psychology of this market changes instantly. Buyers who have been conditioned to buy every dip will suddenly question their strategy. Sellers who have been afraid to short will suddenly find courage. A break of 79.59 would not just be a technical event, it would be a psychological massacre. But we are not at 79.59. We are at $94.11. We are 18% above the trend line. We are in uncharted territory. And that is both exciting and dangerous. The 50-day moving average sits at 65.34. This is another critical trend indicator. When a market is trading this far above its 50-day average, it is considered extended, stretched, vulnerable to mean reversion. The last time silver was this extended above its moving average was during the silver squeeze of 2021. We all remember how that ended. Now, let us talk about the levels that matter for traders who want to buy the dip. The daily chart has identified three key 50% retracement levels: $83.67, $81.79, $69.53. These levels represent value. When a market is in an uptrend, pullbacks to these retracement levels offer opportunities for buyers to enter at better prices. But here's the question. Will we get a pullback? Or will the rally continue without offering a decent entry? This is where Friday's price action becomes critical. Silver finished the week with back-to-back losses for the first time since January 8th. On Thursday, sellers pushed the market lower. On Friday, sellers pushed it lower again. For the first time in weeks, the momentum shifted. The buyers who had been in control suddenly found themselves on defense. But here's what is fascinating. Despite the two-day decline, buyers came in each session to buy the dip. The market closed just under the high of each session. This means the sellers could not maintain control into the close. The bulls kept fighting back. This is why Sunday night opened with a gap higher. The buyers who were watching Thursday and Friday's action realized something. The dip was being bought. The trend was intact. The pullback was an opportunity, not a trend change. So they bought the open. They pushed the market to $94. $11. They made history. But here's the danger. Friday's close was $90.12. If silver closes below this level today, it will produce what technicians call a closing price reversal top. This is a pattern that signals the end of a rally. It does not change the trend to down, but it shifts the momentum to down. It tells buyers to be cautious. It tells sellers that their moment may be coming. The reversal pattern is the weapon JPMorgan is betting on. They see the extended nature of this rally. They see the gap between price and the moving average. They see the back-to-back losses. They believe a correction is coming. But here's what they are not telling you. Trend lines do not care about bank opinions. Moving averages do not care about analyst notes. The only thing that matters is price. And right now, price is telling you the bulls are winning. In part 3, we are going to break down exactly what JPMorgan said in their note. We are going to analyze each of their 4 warnings. And we are going to determine whether they are trying to help you or trying to scare you out of your position. The technical battlefield has been mapped. The levels have been identified. Now we need to understand the enemy's strategy. Let us talk about JPMorgan. Let us talk about the bank that has paid $920 million in fines for manipulating the precious metals market. Let us talk about the institution that employed traders who were literally convicted of spoofing. Spoofing is the practice of placing fake orders to move the price, then canceling them before execution. It is illegal. It is fraud. And JPMorgan did it systematically for years. So when JPMorgan releases a note warning that silver is vulnerable to a sharp correction, you have to ask yourself a simple question. Are they warning you? Or are they positioning you? Let me break down exactly what they said. There are 4 specific risks they highlighted. Let us analyze each one. Risk. Number 1, loosening ex-US supply. JPMorgan claims that supply outside the United States is loosening. This means they believe more silver is becoming available on the global market. If true, this would be bearish. More supply means lower prices. But let us examine this claim. Where is this supply coming from? Mexico is the world's largest silver producer. Their output has been declining due to mine depletion and permitting issues. Peru is the second largest producer. They have been dealing with political instability and community protests that have disrupted mining operations. China is a major producer, but they consume almost everything they produce domestically. So where exactly is this loose supply? JPMorgan does not say. They make the claim without providing evidence. This is not analysis. This is narrative. Here is what is actually happening. The COMEX registered silver inventory has been declining. The London Bullion Market Association vaults have been bleeding metal. The U.S. Mint has suspended Silver Eagle production multiple times due to blank shortages. If supply was loosening, why is every major institution struggling to source physical metal? I will tell you why JPMorgan is pushing this narrative. Because they are short. They hold one of the largest short positions in the silver market. If the price keeps rising, they lose billions. They need the price to fall. They need you to sell. This warning is not investment advice. It is self-defense. Risk number 2, ETF outflows. JPMorgan points to ETF outflows as a bearish signal. They claim that investors are pulling money out of silver ETFs, which suggests waning demand. Let us examine this more closely. Yes, some silver ETFs have seen outflows in recent weeks, but why? Is it because investors do not want silver? Or is it because investors do not trust the ETFs? After the silver squeeze of 2021, a growing number of investors realized that ETFs are paper silver. They are not real metal. When you buy SLV, you're not buying silver. You're buying a claim on silver that may or may not exist. The fine print of most silver ETFs allows them to settle in cash if they cannot deliver metal. This is not ownership. This is a promise. The smart money is not selling silver. The smart money is selling paper silver and buying physical silver. The ETF outflows are not a sign of weakness. They are a sign of awakening. Investors are moving from Wall Street's casino chips to real money. JPMorgan frames this as bearish. I frame this as extremely bullish. The migration from paper to physical tightens the real supply. It puts pressure on the COMEX, exposes the fractional reserve nature of the precious metals market. Risk number 3, softer industrial demand. This is the most sophisticated argument in JPMorgan's note. They claim that industrial demand for silver is softening. Silver is used in solar panels, electronics, electric vehicles, and medical devices. If industrial demand falls, the price should follow. But let us look at the actual data. The solar industry installed record capacity in 2024. Electric vehicle sales hit all-time highs. 5G infrastructure build-out continues at aggressive pace. AI data centers are consuming massive amounts of electronics. Where exactly is this soft demand? JPMorgan does not provide specifics. They make a vague claim about softening demand without quantifying it. This is fear-mongering dressed as analysis. Here is the reality. Industrial demand for silver is structural. It is not going away. It is accelerating. The green energy transition requires silver. There is no substitute for silver in high-efficiency solar cells. There is no substitute for silver in EV contacts. The industrial demand story is a multi-decade tailwind for silver prices. Risk number 4, tighter Chinese trading curbs. This is perhaps the most interesting risk JPMorgan mentioned. They note that China has implemented tighter trading curbs on silver. This means Chinese traders face more restrictions when speculating on silver prices. Why would China do this? Because the price is rising too fast. Because their traders are making too much money. Because the regulators are afraid of a bubble. But think about what this actually means. China is not restricting silver because they think it is worthless. No, they are restricting silver because they are afraid of how valuable it is becoming. This is a bullish signal disguised as a bearish one. When a government restricts access to an asset, it tells you the asset is desirable. If silver was going to crash, why would China need to curb trading? They would simply let the market fall naturally. The fact that they are intervening tells you the opposite of what JPMorgan claims. It tells you the demand is real and the government is scared. This is the pattern we have seen throughout history. Governments restrict gold and silver when they are losing control of the monetary narrative. The restriction is not a warning to sell, it is a confirmation to buy. In part 4, we are going to confront the ultimate question. Who is right? The bulls who just pushed silver to 94.11? Or JPMorgan who says a sharp correction is coming? The answer will determine the next $1,000 in your portfolio. We have reached the critical junction. On one side, you have the bulls, the stackers, the believers, the people who have been accumulating silver for years, waiting for this moment. They see $94.11 as just the beginning. They see $100 as inevitable. They see $120, $150, even $200 in the not-too-distant future. On the other side, you have the bears, JPMorgan, the institutions, the short sellers. They see $94.11 as the top. They see a sharp correction coming. They see $70 or even lower before this is over. Both sides cannot be right. One of them is about to be destroyed. Let us examine the bull case first. The bulls point to the price action. Silver just made a new all-time high. It gapped higher on Sunday night despite thin holiday trading. Every dip is being bought aggressively. The trend is up. The momentum is up. The The market is telling you clearly and loudly that demand exceeds supply. The bulls point to the fundamentals. Industrial demand is accelerating. Investment demand is exploding. Central banks are buying gold, which lifts the entire precious metals complex. The dollar is losing purchasing power. Inflation is sticky. Real interest rates are negative when you account for true inflation. All of these factors are bullish for silver. The bulls point to the supply crisis. Mines are depleting. New discoveries are rare. Permitting takes years. Even if silver hits $200, new supply cannot come online quickly. The market is structurally short of metal. This is not a temporary imbalance. This is a permanent condition. The bulls also point to the silver to gold ratio. Historically, this ratio has averaged between 15 to 1 and 40 to 1. Right now, it is trading around 50 to 1. This means silver is historically undervalued relative to gold. If the ratio reverts to its historical mean, silver has significant upside even if gold stays flat. Now let us examine the bear case. The bears point to the extended nature of the rally. Silver is trading 44% above its 50-day moving average. This is extreme by any historical standard. Markets do not go up in a straight line. They correct. They consolidate. They shake out weak hands before resuming the trend. A pullback is not just possible. It is probable. The bears point to the back-to-back losses on Thursday and Friday. For the first time since January 8th, sellers won 2 consecutive days. This is a change in character. This is the market telling you that buyers are getting tired, that profit-taking is increasing, that the easy money has been made. The bears point to the closing price reversal pattern that could form today. If silver closes below Friday's close of $90.12, it would signal that the gap higher was a false breakout, a bull trap, a final burst of euphoria before the correction. This pattern has marked major tops throughout market history. The bears also point to JPMorgan's specific concerns. ETF outflows suggest institutional investors are reducing exposure. Chinese trading curbs will reduce speculative demand. Loosening supply outside the U.S. will provide more metal to the market. Industrial demand may soften if the economy slows. So who is right? Here's my analysis. Both sides have valid points. Both sides are partially correct. But both sides are missing the bigger picture. The silver market is not a normal market. It is a manipulated market. It has been manipulated for decades. The paper price on the COMEX is set by a handful of large institutions who trade more silver in a single day than exists in all the vaults combined. This is not conspiracy theory. This is documented fact. It is the reason JPMorgan paid $920 million in fines. In a manipulated market, traditional analysis has limited value. The fundamentals can be bullish for years while the price goes nowhere. Then suddenly, without warning, the manipulation breaks. The price explodes. The shorts scramble to cover. And the move is far more violent than anyone expected. I believe we are witnessing the breakdown of the manipulation right now. The physical market is overwhelming the paper market. The COMEX is bleeding inventory. The mints are running out of blanks. The dealers are implementing minimums and rationing. These are not signs of a normal market. These are signs of a market in crisis. JPMorgan's warning is not analysis. It is desperation. They are short. They are losing. They need the price to fall so they can cover. Their note is a psychological operation designed to scare retail investors into selling. Do not fall for it. But here's the nuance. A correction is possible. In fact, it is likely. Markets do not go up in a straight line. The extended nature of this rally means a pullback to the trend line around $80 would be healthy and normal. It would shake out the weak hands. It would reset the momentum indicators. And it would provide a better entry for those who missed the initial move. The question is not whether a correction will happen. The question is whether the correction will be the start of a new bear market or just a pause before the next leg higher. I believe it is the latter. The fundamentals are too strong. The supply is too tight. The demand is too relentless. If you're holding silver, do not panic sell on a correction. If you're not holding silver, use the correction as an opportunity to accumulate. The trend is your friend until it bends. And right now, the trend is emphatically up. In the final part of this deep dive, we are going to discuss strategy. We are going to identify the specific price levels to watch. We are going to explain what to do if the market goes up and what to do if it goes down. The war between bulls and bears will produce a winner. Make sure it is you. We have covered a lot of ground. We have analyzed the record high at $94.11. We have decoded JPMorgan's warning. We have examined the technical structure. We have weighed the bull case against the bear case. Now it is time to translate all of this intelligence into action. Because information without action is worthless. You did not watch this entire deep dive to feel informed. You watched it to gain an edge, so let me give you that edge. Strategy number 1. Define your levels. The most important level on the downside is $90. That is 12. This is Friday's close. If silver closes below this level today, we have a closing price reversal top. This is a warning sign. It does not mean sell everything, but it means be cautious. It means tighten your stops if you are trading. It means do not add to positions until the dust settles. If the reversal pattern confirms, the next level to watch is $83.67. This is the first 50% retracement level. This is where I expect the first wave of buyers to step in. If you are looking to accumulate on a dip, this is your first target. Below that, we have 81.79 and then 79.59, which is the trend line. The trend line is sacred. If it breaks, the character of this market changes. We go from buy the dip to neutral. We wait for confirmation of a new trend before committing capital. On the upside, the key level is $94.11, the new record high. If we close above this level, the bulls have won the day. The momentum continues. The next target becomes $100, which is a psychological magnet. Beyond that, technical projections point to $120 based on the measured move from the November low. Strategy number 2, size your position. In a volatile market, position sizing is more important than entry price. It does not matter if you buy at the perfect level if your position is so large that a normal pullback wipes you out. The number one rule of trading is survival. You have to be in the game to win the game. I recommend allocating no more than 5% to 10% of your portfolio to precious metals unless you are a specialist. Within that allocation, diversify between gold and silver. Within silver, diversify between paper products like ETFs and physical metal. Physical metal should be your core holding. This is your insurance policy. This is the metal you do not sell regardless of what the price does. Paper products are for trading, for capturing short-term moves, for generating cash that you can then convert to physical. Never go all in on a single trade. Never bet the farm on a single day's price action. The market will give you many opportunities. You only need to catch a few of them to change your life. Strategy number 3, ignore the noise. JPMorgan's warning is noise. CNBC's opinion is noise. Twitter's hot takes are noise. The only signal that matters is price. Price is the ultimate truth teller. It incorporates all known information. It reflects the collective wisdom of millions of participants. When the price is making higher highs and higher lows, the trend is up. When the price is making lower lows and lower highs, the trend is down. Everything else is commentary. This does not mean ignore fundamentals. Fundamentals drive the long-term trend. But in the short term, price is king. Trust the chart. Follow the trend. Let the market tell you what to do. Strategy number 4, prepare for volatility. Monday is a U.S. bank holiday. Trading will be thin. Moves will be exaggerated. A gap up could extend further than normal. A gap down could be more vicious than normal. This is not a day for aggressive trading. This is a day for observation. Watch how the market behaves. Watch whether the dip buyers step in. Watch whether the sellers can maintain pressure. The holiday session will reveal the true character of this market better than a normal session would. Let the market show its hand before you make your move. Strategy. Number 5, protect your community. Before I close, I need to address something important. We are Boring Currency. This is the original channel. We have spent hours analyzing this price action, decoding JPMorgan's note, and presenting you with actionable intelligence. But there are copycats. There are fake channels stealing our content, mimicking our style, and trying to trick you into thinking they are us. They are not. We have one channel. It is this one. We are only on YouTube. We do not have a Twitter account. We do not sell crypto. We do not ask for money on Telegram or WhatsApp. If you value this analysis, if you found this deep dive useful, I'm asking you to do one thing. Go to the comments right now and type, "Staying with the original." This tells the algorithm that you are engaged. It helps us fight the fake channels. It builds our community stronger. We read every single comment. Your support means more than you know. In a world of fake news and manipulated markets, we are trying to bring you the truth. Help us continue that mission. The final verdict. Silver hit $94.11. JPMorgan issued a warning. The market is at an inflection point. Here's what I believe will happen. In the short term, a correction is possible. The market is extended. The momentum is stretched. A pullback to the $80 to $85 range would be healthy and normal. In the medium term, the trend remains up. The fundamentals are too strong. The supply is too tight. The demand is too relentless. Any correction will be bought. In the long term, silver is going much higher. The paper manipulation is breaking down. The physical market is in control. The monetary system is unstable. Silver is one of the few assets that protects you from what is coming. JPMorgan can issue all the warnings they want. They are fighting a losing battle. The people are waking up. The metal is moving from weak hands to strong hands. The price will reflect reality eventually. You now have the intel. You have the levels. You have the strategy. The only question is whether you will act. The record has been broken. The warning has been decoded. The battle plan is set. Welcome to the Silver War. Stay safe, hold your metal, and remember, clarity is power. This is Finance Currency. The original, the only. Subscribe.